Hi everyone. Today we are going to learn about the accounting principles, concepts and conventions. Let us first discuss this para. The responsibility of discipline of accounting is to provide financial information to the users of accounting information. This means the purpose of accounting is to disclose the financial information such as financial statements like balance sheets, profit and loss account and cash flow statement. These financial statements is used to know about the financial condition of the business. In making consistency, in making consistency the financial information of the business, such as financial statement, to make the uniformity and consistency in financial statements, a generally accepted accounting principles is followed. This generally accepted accounting principles is nothing but rules which is generally accepted and developed by this discipline of accounting. Such as this generally accepted accounting principles, it develops the standards, the concepts and conventions. The standard in India, the standard is developed by Institute of Chartered Accountants of India, and all companies are bound to follow it. Okay, all right. Okay, you have understand what is the meaning of principles. It's generally means rules. Consistently make accounting. Okay. These principles is further divided into accounting concepts and conventions. There are 9 accounting concepts and four accounting conventions. The accounting concepts is further discussed here. Entity concept. This concept is very easy concept because in accounting, as an accountant, we account in point of view of business, not in point of view of the owner who invested the capital. Okay, we have to treat the business owner as separate from its entity, because we as an accountants, we do accounting in point of view of business, not in point of view of business owners. Okay, in point of view of business means that we treat the capital which is introduced by the business owner into the business as a liability. We should pay back when winding up of the business. Okay, the next concept is going concern concept. This is also a very easy concept to understand. This concept literally means that a business is going concern. Its perpetuity is unknown. Its life is unknown. It will be going on. We anticipate that business will last forever. Okay, but in reality, the business doesn't perpetually last forever, because we dissolute the business. If the business we liquidate the business if business isn't giving the results we need. Okay, but in accounting we should treat the business as an going concern. It is perpetuity. Business has a perpetuity. It will we have to anticipate that business will further go on. Okay, that's why we give supplies on credit, we get supplies on credit. Okay, this periodicity concept is connected with this going concern concept, because if business is infinite, then when the question when arises, when will we come to know the financial positions of the business, financial position of the business or financial condition of the business, such as is business getting profit or loss? How we will define if the business is infinite life? That's why we divided that infinite life of the business into periods, such as an accounting period. An accounting period is, it starts from 1st April to 31st March. Okay, it's very important to know the accounting, financial accounting year. Okay, it's a financial accounting year. That's the period we ought to calculate the financial position of the business in 31st March. Okay, that's periodicity concept means. Money measurement concept. This concept is very easy concept, because if we have machineries, assets in our company, and we if we don't value it in monetary values, then how can we come to a conclusion that this business contains this much financial position, this much assets and liabilities? Okay, that's why this money measurement concept is introduced. Because if assets, if a company has 25 computers, if 25 computers is just shown on the assets, and if we don't calculate the monetary values, then the 25 computers literally means nothing. Okay, if we give a monetary value to the computers, then only the computers is a computer is purposeful in the assets side in the balance sheet. Okay, now let us disclose about the accrual concept. Let us see a small short clip about it. Okay, business. If a business sold goods on cash to Mr. Bean, the cash is realized immediately in the sales transaction. Whereas, if a business sold goods on credit, cash is unrealized, but an asset account is increased instead of that. Okay, that asset account is known as debtors account. Okay, if we there are two methods of accounting basis. One is cash basis and credit basis. If we follow the cash basis of accounting, it will not that much give the true fair value of the business. Okay, that's why we uh, we recognize the accrual concept. Accrual concept is, if we sold goods on credit, if the sale proceeds, if the sale ends, we we should uh, we should give an entry into the accounts. Okay, we don't want to wait till the purchaser to remit the cash. Okay, instead we are creating a debtors account. A debtors account is an asset account, and he's liable in future to pay back to us. Okay, dual aspect concept. This concept is very easy concept, because every debit has an equal credit. Okay, that's meant by dual aspect. Every debit is equal to credit. Example, assets, um, expenses, and drawings. These three things have debit balance. Okay, liability, capital, revenue. These three has credit balance. These three and this three is equal. This we will further disclose detailedly in accounting equation. Okay. Now just understand like this: assets, expenses, drawings, liabilities, capital, revenue. This debit balance, this is credit balance. This is equal to this. Okay, let us discuss about the matching concept. This matching concept is also a very easy concept. All right, because this concept is this concept says that we have to match the expenses to that uh, revenue is remitted in the period. Okay, if example, let's say this month uh, we have an expense of rupees 10,000, and we have and we have an revenue of rupees 15,000. But we incurred that expense 10,000, and 2,000 of the benefit of the expense is not realized in this period. Okay, and if it isn't realized in this period, then we should not match the expenses totally with the revenue occurred in this period. Okay, if we done that, then this accounting period reflects more profit, and the next accounting period reflects less profit than it actually is. Okay, that's why we have the matching concept. We should match the expenses with the revenue occurred in this period. Okay, realization concept. This concept is a very easy concept, because until and unless we realize the sales, if just think an example that Mr. John and Mr. Bean. Okay, Mr. John has uh, gave a sales order to Mr. Bean of 10 units. One unit is rupees 100. Okay, 10 units, 1,000 rupees. This is a sales requirement is given by Mr. John to Mr. Bean. Okay, now Mr. Bean haven't sold anything to Mr. John. Okay, this sales order itself doesn't mean any realization, any revenue to the business. Okay, if Mr. Bean sold sold the requirement of the Mr. John, okay, the 10 units, okay, if he sold the 10 units, then only the revenue is realized as sales transaction. Either it can be Mr. John can pay cash, we realize cash, or Mr. John can take the goods on credit. If he take the goods on credit, he is liable to pay in future, then he is an asset, he is an debtor to us. Okay, that's literally mean by realization concept. Okay, it's clear. All right, let's move on to cost concept. The cost concept is very easy concept, because if we acquire any asset, then the expenses occurred in acquiring that asset is a capital expense. Okay, because if we acquire an asset is a capital expenditure. In that, if we occur any expenses regarding it, we should add the expenses to the capital expenditure. That means that asset, we should add the expenses to that cost of the asset. Okay, that is literally meant by cost concept. In the book there is an example. For example, a packing machine was purchased by Bharat Limited for rupees 40 lakh. An amount of 30,000 was spent on transporting the machine to the factory site, and further rupees 20,000 was additionally spent on its installation. Hence, the total amount of which machine will be recorded in the book of accounts would be aggregate of all these costs. Okay, that is capital now. We should add all the expenses to that cost of the asset. Okay, that is meant by cost concept. Here you see 40 lakh plus 30,000 plus 20,000. It literally 40 lakh 50,000 rupees. Okay, accounting conventions. There are 4 conventions of accounting. This convention is very easy. Okay, convention of conservatism. This convention of conservatism defines that we should anticipate for all losses, all possible losses, and uh, we should not anticipate any future gains. Okay, this is a convention of this conservatism. There is an proverb in Tamil that kadamai chei palanai edirparade. That means do your duty, don't anticipate any gain. Okay, that's the meaning of this convention of conservatism. Okay, this is very easy convention. Okay, next, convention of consistency. If we have followed a type of standards in a period, and if you are deviating, if you are changing the standards in another period, that means there will be a collapse. There will be a confuse in disclosing the correct true financial position of the business. So we should be consistent in following the standards and principles of the business. Okay, that means convention of consistency. Convention of materiality is very an easy convention. Okay, because material facts of the business may be useful in a period. Okay, and the same business, it can be unuseful to the later period. Okay, materiality convention defines that a material can be very useful to an organization, and the same material can be useless to other organization. That's meant by convention of materiality. Convention of full disclosure means that an accountant, he should do his job very honestly to disclose all the financial position of the business, because the owners of the business, like if a large company, the company's shareholders may not take part in every aspects of the business. Okay, the management takes part in the aspects of the business. In case of company, in that time, full disclosure is very important. We have to reveal the true financial position of the business. It's the duty of the accountants or management to disclose the true fair value of the business. Otherwise, it will be an act of forgery. Okay, this convention of full disclosure is very important convention. Okay, we have disclosed today about all the accounting principles further divided into 9 concepts and 4 conventions, and we have saw what does accounting principles literally mean, the rules, why we have these rules, everything in this video. And thank you for watching. Stay tuned. Comment in the comment section that I may develop my skill furthermore, and I will provide the knowledgeful information for you. Thank you very much.